Welcome to The Explainer. Today, we are diving into something that could be a huge time saver for finance teams everywhere. I'm talking about a brand new accounting standard called IFRS 19. All right, here's how we're going to break it down. First, we'll talk about this massive headache that so many companies face, disclosure overload. Then, we'll introduce the solution, IFRS 19, and see who can actually use it. We'll get into the nitty-gritty of what disclosures get the chop, and, most importantly, we'll unpack why this is such a potential game changer for you. Okay, so first things first, why do we even need a whole new accounting standard? Let's really dig into the problem that IFRS 19 was created to solve. So, if you've ever had to prepare financial reports for a subsidiary, this is probably going to sound very familiar. You know that feeling? It's like you're forced to use this massive, complicated rulebook that was built for giant multinational corporations, and it honestly feels like you're using a sledgehammer to crack a nut. And this really paints the picture perfectly, doesn't it? On one hand, you've got the full, incredibly detailed IFRS standards, the ones designed for huge public companies with tons of stakeholders. But on the other hand, you've got the subsidiaries reality. They have to follow the exact same rules for how they recognize and measure things. The math is the same, but then they get absolutely buried under this mountain of disclosures that, frankly, aren't even relevant to their users. Well, it's exactly this disclosure burden, this problem that the International Accounting Standards Board, or the IASB, set out to fix. And their solution? It's called IFRS 19. This is the new standard that basically gives eligible subsidiaries a green light to massively slim down their disclosure requirements. And the best part, they can do all this while still being fully compliant with IFRS accounting standards. Now, this is the really crucial part to understand. IFRS 19 doesn't change the math. You still apply all the same recognition and measurement rules from all the other IFRS standards. So how you count your assets, liabilities, revenue, all of that stays exactly the same. The huge change is that you get to throw out those thick disclosure sections from the other standards and replace them with the much, much simpler and more streamlined requirements found right inside IFRS 19. And you should know this is hot off the press. The standard was just issued in May of 2024, and it'll become effective for companies to use pretty soon. So right now is the perfect time to get up to speed and figure out what this means for you. Okay, so this all sounds fantastic, right? A simpler path. But the big question is, who actually gets to take this path? Let's jump into the eligibility criteria. All right, the eligibility test, and this comes straight out of the standard, by the way, is actually a pretty simple three-part checklist. Okay, step 1, you've got to be a subsidiary. Simple enough. Step 2, you can't have what's called public accountability, and we'll talk more about that in a second. And step 3, your parent company has to produce publicly available consolidated financial statements that are already using full IFRS. So let's zoom in on that second point, public accountability, because this is a really key term. It doesn't just mean your stock is traded on an exchange. The definition is actually a bit broader. A company has public accountability if its shares or its debt are traded on a public market, or if its main job is to hold assets for the public. Think of a bank, a credit union, or an insurance company. So if your subsidiary doesn't do any of those things, you've just cleared a major hurdle. Okay, so let's say you've checked all the boxes and you're eligible. Awesome. But what does reduced disclosure actually mean in the real world? What are we talking about here? What gets cut? Well, here's the best way to think about it. Instead of trying to list every single thing that gets removed, which would be a crazy long list, it's much simpler. IFRS 19 basically gives you a brand new, streamlined checklist. It completely replaces the disclosure requirements from over 30 other IFRS and IAS standards. So you're not just crossing things off an old list, you're picking up a whole new, much shorter one. And this table gives you a fantastic little snapshot of what that looks like in practice. For example, let's look at IFRS 7, financial instruments. All that extensive analysis of credit risk, liquidity risk, market risk, gone. Instead, you just focus on the core info. Or how about IFRS 16 for leases? The pages and pages of detailed info get boiled down to a simple list of key expenses and carrying amounts. It's the same story with revenue recognition under IFRS 15. The pattern is crystal clear. Keep the information that's truly essential and get rid of all the extra noise. All right, let's bring this all home. Why does any of this matter to you? Let's talk about the key takeaways. When you really look at it, the potential benefits of adopting IFRS 19 are huge. We're talking about the potential for some serious cost savings, both in the time it takes to prepare the reports and in your audit fees. Your whole reporting process could become faster, more efficient. But, it's not just about saving money, it's about clarity. Your financial statements become cleaner, less cluttered, so the people reading them can actually focus on what's important for that subsidiary. And the absolute best part? You get all of this and you are still 100% compliant with IFRS accounting standards. So, the real question to think about is this: could IFRS 19 be the key for your company? Could it be the thing that finally streamlines your financial reporting, cuts down on costs, and maybe most importantly, frees up your team to focus on the things that actually drive the business forward?